If you look at the chart of Bitcoin, it's not a great looking chart. It fell very, very quickly. We've talked about a lot of the reasons why, but it is starting to act better here. And I do believe, and I've said this, that I've got a lot of buy signals on things that I have. I'm looking at a lot of things that say that if we can get above 93,000, I expect there to be kind of a surge back up to 100. I think right now, you've got credit spreads at all-time types. You've got the reflation trade going on. I strongly believe PMIs are going higher. And for me, that means that Bitcoin is just kind of, whether it stays here between 85 and 92 for another couple weeks, when we get into the beginning part of next year, I think we're going to see Bitcoin back above 100. And I think the surprise will be back to all-time highs in the first quarter.
Markets tend to confuse volatility with meaning. A sharp move down is often mistaken for a breakdown, while a quiet consolidation is dismissed as weakness. But for experienced macro investors, those moments are usually where the most important signals begin to emerge, especially when liquidity, policy, and growth expectations quietly start to shift beneath the surface. That's the lens Jordi Visser brings to the current Bitcoin setup in his latest discussion with Anthony Pompliano. After a rapid drawdown that left sentiment visibly shaken, Jordi argues the chart itself is beginning to stabilize at the same time that broader macro conditions are turning more supportive. His focus isn't on day-to-day price action, but on what happens when technical levels, improving risk appetite, and a changing Federal Reserve stance start aligning. In his view, Bitcoin holding the mid-$80,000 to low $90,000 isn't failure, it's construction. What makes this especially important is timing. Jordi isn't calling for an immediate breakout driven by speculation. He's pointing to a setup where improving PMIs, tight credit spreads, and reflationary signals could allow Bitcoin to regain $100,000 and potentially push to new all-time highs as early as the first quarter. Ethereum's relative strength, meanwhile, is reinforcing the idea that crypto markets are beginning to price in a healthier growth environment rather than a risk-off regime. And this is where the story really starts. Because Jordi's confidence in higher crypto prices isn't coming from charts alone, it's coming from what the Fed just did, and more importantly, how they did it. In this video, we'll break down why Jordi believes the latest rate cut may be the most important policy signal since 2021, what it tells us about the real state of the US economy, and why it could be laying the groundwork for the next major leg higher in Bitcoin and digital assets. If that sounds valuable, make sure you like the video, subscribe to the channel, and stay with us till the end so you don't miss any important part of the puzzle. Thanks for tuning in and enjoy the video.
The actual cut was not a surprise, obviously. We had, the committee had worked our way up to 90+%. But I think there were a lot of nuances in this that are definitely important for markets. And I think for the messaging side, we talked after the last Fed meeting, and I mentioned the fact that Powell has gradually, since really Jackson Hole, been working his way towards this position of labor versus inflation, but at the same time, the progression related to artificial intelligence. And I think this is an important time in history where we've reached a point where, starting in really September through October and now with this most recent meeting, he has basically talked about artificial intelligence and the impact that it's having. Now, at this meeting, I think the most important point that he made was really the focus on the labor side. You and I have talked about the reality of the labor market being weak. Last week when we spoke, I highlighted the fact that 6 of the last 7 months, we've had negative job creation for small businesses, less than 50 employees in those small businesses. And I think the Fed has a dual mandate, but they also have to deal with the K-shaped economy. And the message that came out was, number one, he implied that the non-farm payroll numbers, the one that we pay so much attention to, are likely overstated by about 60,000 jobs. It's a big deal. He also talked about the expectations that inflation was coming down. He talked about the productivity being at the higher level, and the fact that we're really not at the AI adoption point yet. So if you put it all together, it was a dovish press conference, and it was a dovish message that came out. And Bloomberg Intelligence, which kind of goes through it with a fine-tooth comb and takes the statements that are more hawkish, more dovish, according to them, it was the most dovish press conference we've seen since 2021. So I think on the whole, when you just take the press conference part, it was dovish. But obviously the other announcement they made, which is important for everyone, is they acknowledged the fact after saying QT was ending, they said they had to start making purchases. Bill purchases will be, starting at 40 billion and likely be around that number until we get through the tax day in April. And so the need, again, of the Fed to be assisting the market on the funding side and the need with this debt and deficit at these levels has become apparent. And so for anyone who wanted to see gold, Bitcoin, the story of kind of the Fed being there to provide liquidity, they got a little bit of everything they wanted on this. And we don't have another cut built in until April to June. But I think for the time being, it was a positive, dovish meeting for everyone who was hoping so.
Jeff Park had this great tweet of they couldn't even make it to January. They could not make it to the end of the year before they had to start buying these treasuries. Do you put any weight on 40 billion, the fact that they had to do it so quickly within weeks of ending QT? Or is that actually what we should have expected? They just didn't telegraph it as much.
Yeah, so I think there's two components, and we tend to forget this stuff. But remember, the government was shut down for a long time leading into this. So I think there's two messages out of that. One is they didn't want to do anything or be involved in anything while the shutdown was going on unless they had to. The funding stress had been showing up, and even though I think they were confident, which most people that follow the Fed were, that the facilities that are open would always enable this to not be a big problem. But I think once you got through the shutdown, two things stand out. Number one, they gave the most dovish press conference in 4 years without having any real new data. I think that should be a statement in itself. And I do think the fact that they brought up the purchases to now just highlights the fact that this is a scenario that why wait until January when they're in a position that they should get this rolling, and the funding stress had been there. So I think there was a legitimate reason to kind of do it now and not have to wait till January. For the last couple months, I've talked about the fact that I think it's going to be a lot harder for tech to continue its let's say its dominance, specifically the Mag 7 and let's narrow it down, the hyperscalers, because I do believe that the hardware side of the economy is going to be fine next year, and that's Tesla and probably Apple as well. But what did work was clearly the things related to what I call the PMI surge. You've got small caps that went higher. Transports ripped higher. You've got a lot of components inside there related to a weaker dollar. You've got the CRB raw industrials metals index breaking out. You've got rates, long-term rates going higher with equities going higher. So you have kind of the perma bears on what bonds are doing. But the reality is we have this whole growth trade going on. So I think the Fed moving rates combined with the expectation that the first quarter is going to see the biggest stimulus part of the one big beautiful bill has people thinking that they should be leaning more towards cyclical pro-inflation related things. And that's the way the market worked out. At the same time, growth underperformed value. That has been kind of a mega trend that's gone on for the better part of this year. But with NVIDIA kind of still hanging off the lows, you had Oracle earnings this week. Palantir is still off. Palantir is off the highs. I was saying NVIDIA is off the highs. You have a lot of these AI fear trades, OpenAI, all of the component pieces that are still there. So on the equity side, it was as expected. For Bitcoin, Bitcoin probably didn't go up the way people would have wanted, but I do want to send kind of a message here. I heard a few podcasts this week with, let me say, macro people that I listen to often. There's not a lot of them still, but the ones I do listen to, they usually at least have a view on Bitcoin. All of them turn negative. One of them I couldn't believe turned negative, but openly said turned negative 3 weeks ago, which I think was the low. If you look at the chart of Bitcoin, it's not a great looking chart. It fell very, very quickly. We've talked about a lot of the reasons why. but it is starting to act better here. And I do believe, and I've said this, that I've got a lot of buy signals on things that I have. I'm looking at a lot of things that say that if we can get above 93,000, I expect there to be kind of a surge back up to 100. If we can have 3 daily closes above 92, that would be good too. But Ethereum already has a good looking chart. You've already broken the downturn trend line. It's kind of outperformed Bitcoin on my stuff in terms of the relative chart relative to the beginning of the year. So I think right now, you've got credit spreads at all-time types. You've got the reflation trade going on. I strongly believe PMIs are going higher. And for me, that means that Bitcoin is just kind of, whether it stays here between 85 and 92 for another couple weeks, when we get into the beginning part of next year, I think we're going to see Bitcoin back above 100. And I think the surprise will be back to all-time highs in the first quarter.
The core of Jordi's argument begins with the Fed. This wasn't just the third rate cut of the year. It was, in his words, the first truly unprovoked dovish cut. Jordi highlights several critical details. Powell implicitly acknowledged that non-farm payrolls may be overstated by roughly 60,000 jobs, reinforcing the idea that labor conditions are weaker than headline numbers suggest. Small business job creation has already been negative in 6 of the last 7 months. Taken together, this was a dovish press conference, not because of what the Fed cut, but because of what they finally conceded. And then came the liquidity signal. The Fed not only ended QT, but quickly moved to restart Treasury bill purchases, roughly $40 billion per month, far sooner than markets expected. For assets like Bitcoin and gold, this matters enormously. Liquidity support, even when quietly framed as funding assistance, has historically been the fuel that reignites risk assets. But Jordi doesn't stop at policy. He zooms out to something even more structural: how the economy itself is changing, why tech dominance is being challenged, why capital is rotating towards cyclicals, and why the next phase of growth may look very different from the last decade. This is where the conversation shifts from short-term market reactions to long-term positioning, and where his most forward-looking insights begin.
Let's say what you're describing is what a recession is supposed to be. So the shedding of the skin, you're supposed to have the weak go out of business and the strong companies survive. If you have bailouts, you allow everyone to survive. And this got most people angry at the government because they're using the balance sheet to bail things out. That occurred during COVID, obviously. That occurred during the great financial crisis. It occurred during SVB. All of these times where the government or the Fed comes in and basically decides to save things, it's a problem. What you said at the beginning, and I just want to make sure people hear this, every single, unless I missed one, every single business of entrepreneurial thing that you mentioned could be done at home. So one of the things people have to remember is we have advanced because of the cloud. So if you go through the iterations of the smartphone, and the reason I brought up going from 3G to LTE, 3G to LTE, people should think about as Blackwell being like 4G. Like you're going to open up so many new businesses. There is no Uber working without LTE. And the reason is, people probably forget this, but do you remember when we first started using Uber before LTE and the car would be stuck and it's not moving, or the app would just kind of freeze? That was because there wasn't enough bandwidth for everything that was going on. All of the apps that have now become mega companies, they depended on this next stage. What you're describing coming out of COVID is the remote work from home. That was not a thing before 2019 in a major way. Now it's normal. My LLC, you know what the business address is? It's my apartment. Everything can now be done at home. I spend most of my time, if I'm not in meetings, working from home because it's the easiest way, because the way I've set it up for me to do the time there, and I save the commute time. I save everything. So I think the economy is changing rapidly. One thing I do want to bring up to people, since I've mentioned this a bunch of times, and whenever there's kind of negative things that are out there in terms of views, I think whenever people talk negatively about technology, most traders get kind of pissed. And the reason is because they want to belong Palantir and belong these things. Next year, I think people have to start to understand that it's going to be a historic 12 to 18 months for IPOs. We're going to have Anthropic come out. We're going to have XAI come to the market. We're going to have OpenAI come, and we're going to have SpaceX come. If you take their market caps now, I mean, you're talking $1.5 trillion, $2 to $2.5 trillion of companies that would go public. Why are they going public while Stripe's not going public? So let's get back to your point. These companies are going public because they need the capital to build out this physical framework to support the intelligence for their businesses. Why did Cursor just raise $3 billion at a $30 billion valuation on the fastest company ever to 500 million ARR? Why did they have to do that? It's a code company. These are new things. And the reason that these are important, and the reason that I'm really more negative on tech, you're going to be bringing a lot of supply to the market next year in terms of IPOs that just has not occurred. And these tech hyperscaler companies, they're doing something they never needed to do, which was borrow money. So back to your original question, the economy is changing rapidly. And I think the age of software dominating is now getting into a reality that at some point the physical world still exists and you still need power to fuel all this technology. You want to be focused on energy. You want to be focused on transportation. You want to be focused on small cap companies that make LiDAR and make sensors and a whole bunch of things along those lines. They've been left for dead. And that's why I keep coming back to the fact that if you want to find one index that represents everything that you're saying, it's the PMIs. If the PMIs break above 50 after 3 years sitting below 50, that is your trigger point that something different is going on in the economy. Jordi, I think there's going to be a recession and millions of people are going to lose a job. Okay, that I put as a low, very low probability event for the same reasons that we talked about during the tariff situation. If someone says, I believe the market's overvalued and we're going to see a 30% correction. Okay, so let's go through. 2020, we had a huge correction. That was for a pandemic. 2022, we had a huge correction. That was because the Fed had to turn around after the pandemic and raise rates shockingly fast. Okay, let's go to 2023. We didn't have a huge fall off, but we had Silicon Valley Bank, basically a digital bank run that had not been seen before. And we got a correction. It didn't last very long, but the sentiment dropped off a cliff. And then we had a 20+% correction, 30% correction, the Mag 7 this year on the back of the tariffs. That's 3 big corrections with a run on a bank, 4 events in the last 5 years. I will say this unequivocally. We will have more 20 and 30% corrections in the next 5 years. There is no doubt in my mind. So it really depends on what you're doing. What I think has happened is each one of those had the same ending. Once the events kind of stopped, the market went right back to all-time highs. And the reason it went right back to all-time highs is because of profit margins, productivity, and the ability of AI and whatever else to impact the companies. That to me is the overwhelming trend that will happen. So I do believe we will see corrections. If you ask me what's the most likely risk to pop up, I believe the CapEx hole is another bearish story for next year, meaning the hyperscalers are spending lots of money. Gavin Baker talked about this air gap in ROIC, meaning until you actually get the Blackwells, you're not going to get your revenues in the door because you can't deploy the amount of product that you need to people until you have the compute. You need the speed because right now I had never had a problem with Google Gemini. You know what's happened now when I'm using it? Hey, come back later. We're busy right now. And this has happened now a few times. This never happened. This was happening with ChatGPT all the time. Now all of a sudden it's happening in Google. What that says to me is we just don't have enough compute still relative to the demand and how fast it's increasing, particularly when you start rolling out video. So I do believe the CDS rise that we're seeing in Oracle is a warning sign that if OpenAI doesn't get their revenue in the door, do I think they'll go bust? No. Do I think this stock could, the private company valuation could go down a lot? Yeah. I just don't think there's a recession that can happen because the reality is we're not having an overinvestment boom in people. Every time we've had kind of a bubble thing, whether it was in 99, we had hired an enormous amount of people without anything going on. We've been in rolling recessions now in this economy since 2020, late 2021 into 2022, housing, commercial real estate. There's all kinds of things, autos, everything's been there. We see the credit card delinquencies. I'm not worried about a big event, but I do think there'll be many 20, 30% corrections just because I think that's the negative that comes with AI.
Jordi's broader thesis is that we're moving into a fundamentally different economic regime, one where the dominance of pure software and hyperscalers gives way to the physical realities of energy, infrastructure, transport, and compute. AI doesn't eliminate the real economy. It amplifies its constraints. Power, bandwidth, logistics, and capital intensity suddenly matter again. That's why he believes PMYs are the most important signal to watch. A sustained move above 50, after years below it, would confirm that something deeper is changing beneath the surface. This is also why Jordi rejects the idea of a traditional recession. We're not coming off an overhiring boom. We're coming out of rolling, sector-by-sector slowdowns that have already purged excess. Housing, commercial real estate, regional banks, and speculative tech have all gone through stress events. Each time, markets corrected sharply, and each time, they eventually recovered to new highs once the shock passed. In Jordi's view, future 20 to 30% drawdowns are inevitable, but they are features of this AI-driven era, not signs of systemic collapse. For crypto, this backdrop is quietly bullish. Bitcoin thrives in environments where liquidity returns, confidence stabilizes, and trust in centralized decision-making erodes. The Fed stepping in early, acknowledging labor weakness, and restarting balance sheet support reinforces the narrative that monetary authorities will act first and explain later. That asymmetry, where downside is cushioned but upside remains open, is exactly where scarce, non-sovereign assets tend to outperform. The key takeaway from Jordi Visser's analysis is simple but powerful. Volatility doesn't negate the trend, it reveals it. If PMIs continue higher, if liquidity remains supportive, and if the Fed has truly pivoted without being forced by a crisis, then Bitcoin pushing back above $100,000 and surprising markets with new all-time highs is not an extreme outcome, it's a logical one. And share your thoughts in the comments. Do you agree with Jordi's outlook on the Fed and Bitcoin, or do you see risks the market is still underestimating? If you found this breakdown useful, make sure to like the video, subscribe to the channel. Thanks for watching, and we'll see you in the next one.